Hello everyone. My team and I are presenting this book that challenges one of the most widely accepted beliefs in the investing that individual investors cannot beat the stock market. But the author Joel Greenblatt argues the opposite and actually explains why individual investors have a real edge. So let's understand it. So first, size is your secret weapon. Unlike large fund, individual investors are not constrained by the scale or the quarterly reporting. This allows such investors to invest in small and attractive investment and attractive companies that are irrelevant for such big institutions. Second, doing your own research is very critical. Tips from sell side and institutional research often suffer from herd behavior and incentive biases. The best opportunities tend to exist in under researched or ignored part of the markets. Third, book clarifies the true role of diversification. Diversification in stock portfolio reduces the company specific risk and not the market risk. Most benefits are achieved with a limited number of well chosen stocks. Beyond that, over diversification only dilutes the return, and diversification should be done among the asset class. Fourth, the author stresses on waiting for the Fed pitch, means investing does not reward the constant action. Capital should be concentrated where conviction and understanding are the highest. And finally, the book highlights messy situations such as spin off, merger, restructuring, or distressed companies where complexity and forced selling often creates mispricing. So, in this book, in this presentation, we will understand these all messy opportunities in more detail. I will be later on, I will be explaining merger and arbitrage. But before that, I will pass on to my colleague Mohit Saini to explain it further. Thank you.
Thank you, Mr. Saurav, for the takeover. I, Mohit Saini, will now continue with the difficult topic that is explained in simple words. Most investors spend their lives looking for the next Apple or Tesla. But what if I told you the real money, the Buffett level returns, is actually found in corporate trash? Joel Greenblatt, one of the greatest fund managers of all time, called this area discarded corporate refuse. We call them spin offs. According to a 25-year study from Penn State, these discarded stocks outperform S&P 500 by 10%. If the market gives you 10% and these give you an extra 10%, you are looking at an 20% annual returns. That is wealth doubling territory. Today, we are breaking down the framework from Greenblatt's masterpiece, You Can Be a Stock Market Genius. What is a spin-off and why do they happen? A spin-off is simple. A corporation takes a subsidiary or a division and then separates it, creating a new independent company. Then they give the shares of the new company to their current shareholders. But why would a company just give away a piece of itself? Greenwald says the reasons are rarely about being nice. His core thesis is that spin-offs are a fundamentally inefficient method of distributing stock to the wrong people. Imagine you own a massive tech conglomerate. Suddenly, you are handed shares of small local textile business. The parent company didn't want anymore. You didn't research it and it doesn't fit your portfolio. It's quite literally an unwanted gift. Immediate selling pressure. Because these shares are small compared to the parents, most investors don't even bother reading the prospects. They sell immediately. This isn't a judgment on business, it's just house cleaning. The institutional dumping. This is where the real alpha is generated. Large institutional funds are often forced to sell their own charters. If a fund is mandated to only holding S&P 500 stocks and the spin-off is too small for the index, they must sell every single share regardless of the price. This creates a massive supply-demand imbalance. Entrepreneurial spark. Once the dust settles, we find a transformed business for the first time. Management is the big fish in a small pond. They are no longer competing for parents' attention. They have their own brand, their own board, and their own budget. Critically, incentives tied directly to the spin-off stock price. How do we filter the dozens of annual spin-offs to find the exceptional ones? We use Greenblatt's 3 signal playbook. Signal 1. Institutions don't want it. We look for forced selling. If the spin-off is less than 10% size of the parent, or if it is in a boring industry like chemicals or manufacturing, while the parent is glamour, it's in tech. We are looking for situations where the selling is based on logistics, not logic. Signal 2. Insiders want it. This is a golden rule for spin-offs. You must look at the SEC Form 10. This document reveals the incentive structures. Are the managers getting a massive grant of stock options? If the management team is willing to take a huge part of their pay in the new company's stock, they are signaling that they believe the stock is undervalued. Signal 3. A hidden opportunity is revealed. The spin off process often uncovers hidden gems that could be a great business trap, a high growth division that was dragged down by a slow growing parent. Sometimes the parent loads off the spin-off with debt or more interestingly, gives it a clean balance sheet with zero debt to ensure it survives. Because of the initial dumping, the stock might trade at a P far lower than its industry peers, created a coiled spring effect. Now you might be thinking, if this is so easy, why doesn't everyone do it? Won't the extra returns disappear? Oh yeah, little faith. As Greenblatt says, these returns are persistent because of the yuck factor. Most investors want a clean, easy story. Spin-offs are messy. They have no history, high debt, and no analyst coverage. And here's the kicker. A random sample of spin-offs get you 20%. But if you pick your spots, the best of the best, you can rival Warren Buffett's 28% annual return. Why is why the second year is key? The Penn State study found the biggest gains happened in the year 2. Why? Because it takes a year for the forced selling pressure to just cool off and a year of new management forces to start actually showing up in the bottom line. You don't need an MBA or a supercomputer to do this. You just need logic and common sense. While the pros are too busy following the herd, you can be digging through the next corporate reviews for the gems they were forced to throw away. Now, Mr. Bhumik will explain real life examples how spin offs occurred and made wealth for the not so cool investors. Thank you.
Thanks, Mohit. Now let's talk about some case studies in the book regarding spin-offs. Let's start with Marriott. The Marriott spin-off example was it wasn't a case of a business suddenly becoming bad. It was a case of a business becoming structurally uncomfortable to own. After the split, post Marriott held properties and very large amount of debt in billions. That level of leverage immediately changed who the natural owners of the stock were. Many shareholders had bought Marriott for its brand driven management fee model. What they received was a highly leveraged real estate business. This is where it's important to not confuse selling pressure with business quality. Hotels and real estate didn't suddenly stop generating cash. What changed was the capital structure magnified risk, making the stock unsuitable for many people, especially institutions with limits on leverage, real estate exposure, and credit risk. Selling in many cases was driven by portfolio rules, not by a judgment that the business was broken. What gave the situation depth rather than making it just a mechanical trade was insider behavior. The Marriott family remained invested, and Stephen Bolenbach, the orchestrator of the deal, took over as the CEO of the host Marriott. These were the people who understood both the assets and the leverage and the business. Yet they chose to stay involved in the host Marriott. That suggested that the business itself was still viable, even if structure made it look unattractive. The lesson here is not simply buy what institutions sell, it is that institutional selling sometimes reflects structural incompatibility, not a negative view on the underlying business. And that distinction only shows up if you actually study the situation. Now let's talk about a partial spin-off case study that was given in the book, Sears. At the time, Sears had partially spun off Dean Witter and OnState, both of which were publicly traded. Since Sears still owned 80% of each, their market values could be directly calculated using their share prices. Greenball then took the total market value of Sears and subtracted the market value of these retained 80% stake. What remained after this subtraction was the value the market was implicitly assigning to Sears' core retail business. When this calculation was done using market prices at the time, the implied value of Sears retail operations came out to be around $11 per share. On its own, that number doesn't mean much unless it's compared to something sensible. So Greenball compared Sears using the same metric he applied to JCPenney, a broadly comparable large US department store chain. This metric used was price to sales ratio. On this basis, Sears at an implied value of $11 per share was trading at much lower price to sales ratio than JCPenney. In simple terms, the market was valuing each dollar of Sears sale far less than each dollar of JC Penney's sale, even though both were large, mature retailers operating in the same industry. This wasn't the case of Sears being the only bad retailer in the world. It was a case of market failing to reconcile the math once part of the company was priced separately. The key learnings here is that partial spin-off can quietly expose contradiction in market pricing. The opportunity didn't come from forecasting a retail turnaround. It came from noticing that market using its own share price was implicitly making a claim it would never explicitly state. And lastly, let's talk about Liberty Media. Liberty Media case shows a third version of the same idea, but this time the mispricing was created not by selling pressure but by structure and required effort. Liberty was spun out of telecommunications through a right offering, not a simple distribution. Existing TCI shareholders received one transferable right for every 200 shares of TCI they owned. To obtain one share of Liberty, a shareholder had to use one right and give up 16 shares of TCI. At the prevailing time, the TCI price was $16 per share. This meant effectively paying $256 to acquire one Liberty share. The rights expired after 30 days. So shareholders had a limited window to decide whether to participate, sell rights, or let them lapse. This structure immediately filtered investors. Participation required shareholders to understand mechanics, commit capital by surrendering existing shares, and take action within a short time frame. Many institutional investors were unwilling or unable to do this because of the mandate constraints, operational inconvenience, or simply because Liberty was a small, complex vehicle with no operating history. What stood out here was the incentives John Malone received options of 100,000 Liberty shares. Depending on how many shareholders participate in the rights offering, these options could represent anywhere from 5% to 10% of Liberty's upside. The fewer Liberty shares issued overall, the larger percentage represented by Malone's option. John Malone at the time was the CEO of telecommunications. So this wasn't complexity for complexity's sake. The structure discouraged broad participation by design, while insiders were positioned to benefit more if participation stayed low. Investors who opted out weren't making a judgment about Liberty's future. They were responding to the effort required, the capital commitment involved, and their own institutional constraints. Thank you. Now, my colleague again, Saurav, would take over.
So we will understand what is merger, how to play the merger, the return risk, and how to mitigate the risk. So first of all, what is merger? So there are two companies, one company acquiring another company. Earlier, they were listed as separate entities. They were separate entities reporting their separate financials. But now they will become merged and single entity. Their financials will also get merged. So let's talk about this deal. It is an Indian case study of Inox Wind Energy Limited, a target company, getting merged into Inox Wind Limited, an acquirer company. Now, these both entities are part of same parent group. This both entity operates into similar kind of business of wind energy. So let's understand what is the rationale or objective behind this merger. So first is streamlining the corporate structure. For parent company, there were two entities operating into wind business. Now there will be only one single entity. Second, the strengthening of financials. The both companies' financials assets will get merged, so balance sheet will become more stronger. Third, it will reduce the public number of publicly listed companies entities for the parent company. Now let's jump onto the deal. What was the deal and what was the swap? So the deal was based on the stock. It was a stock deal. So target company's shareholder will get stock of acquirer's company at the time of merger. So announcement of merger was made on 12th June 2023. At that time, the initial swap ratio was about every 10 shares you hold of Inox Wind Energy Limited, you will get 158 shares of Inox Wind Limited. But after that, there was a bonus issue in Inox Wind Limited of 3:1. So every one share you will get additional 3 shares. So the post bonus, the ratio was every 10 is to 632, like 158 into 4. Now let's talk about the prices during this 2-year duration. So first, we need to understand that there are two main important things. First is that the swap value is totally dependent on the price of acquirer's company's share price. If As when limited share price falls or goes up, it will directly impact the swap value. Second, the spread, which is a return from the merger deal. It is dependent on the valuation gap between swap value and the target company's share price. Okay. So on 12th June 2023, announcement was made. And for example, you did research and then you decided to invest on 3rd July 2023. At that time, the pre-bonus share price of Inox Wind Limited was 162 rupees. And if we calculate the swap value for per share of target company, it would be 162 into 15.8 will be the 2557 of swap value. So if you had invested into Inox Wind Energy Limited at that time, you would have made return of about 19%. But there is one problem. You don't know the record date. It could be 6 months, 1 year, 2 years, right? You don't know the record date. So when will you sell that? So one question you might have that what if the target company's share price goes above the swap value before the record date, right? So let's understand the spread over this 2 year duration. So as I calculated the spread, the average spread in the 2 year duration was 19%, somewhere 35% difference, somewhere 11%, but average was 19% difference. And as the record date was disclosed and as the deal came near completion, the possibility of deal happening increased, and second, the time value reduced, and because of that, the spread also narrowed down. So if you had invested around this time, you would have made about return of about 1 or 2%, right? So now let's talk about return and risk. You would have made a return of about 19%, which is 9% CAGR for 2 year return. But there was also a risk. There was also a risk. The what if the Inox Wind Limited share price falls significantly before the record date, maybe because of market slowdown or poor fundamentals? It will directly impact your swap valuation. Your 19% return will get impacted. It may go fall. It may be low return or maybe negative return also. So, how to mitigate that risk? Let me help you understand the risk arbitrage trade. It is a market neutral trade that we will buy a target company's shares and short sell the acquired company's share based on the swap ratio. And it will help us neutralize the market risk and secure our the predictable profit. So let's understand what is the trade, how we will do, and what will the payoff. So on 3rd July, we will initiate the trade. At that time, we will buy 10 shares of Inox Wind Energy Limited. So our buy position will be 21,500, and we will short sell the same amount of shares when we will get at the time of swap at the merger. So we will short sell the Inox Wind Limited 632 shares. By this short, uh, so our initial profit is about 4,096, which is 19% return from the merger trade. Now, because of this short trade, we are now immune to the market fluctuation risk. Whatever happened to Inox Wind Limited share price, it may go up, may go down. It will not impact our 19% return. Let me help you understand it. So, for example, if Inox Wind Limited shares fall significantly, our short position will be profit. Our short position will have profit, and by that same amount, our long position will have loss. So at the time of swap, what will happen? We will use these 632 shares to cover our short position. So our profit will nullify our loss. So it will become zero, and 4,096 will become our profit, which is 19%. So this was the merger. We understood the return, risk, the arbitrage, and how we will do this risk arbitrage trade. So thank you. Now I will pass on to Tariq.
Thank you, Saurabh. Hi, I am Tariq, and I will be presenting to you about a special situation called bankruptcy where you can make money. So, in the first slide, I will tell you the framework of bankruptcy. Why does it lead to bankruptcy, and how can it lead to bankruptcy? What does the management do to come out of the bankruptcy? And when you should invest in a company. The first one is that the company might hit an iceberg. Now, what are these icebergs? These icebergs are excessive debt taken by the management or the debt taken during the upcycle of the management to upscale the manufacturing plant and capacity, debt taken by the management for doing LBOs, some regulatory changes which might lead your company to hit an iceberg. The second step is that the management has to come up with a new plan, the rescue plan. Now, what happens in the rescue plan is the company makes a deal with its previous owner, bondholders, and creditors. They try to give the new stock of the new company to this party so that they can sell those stocks in the market or keep them. When they sell those stocks in the market, the price falls naturally because these are the anxious sellers who don't want the company in their portfolio. This is why these companies are termed as orphans, termed by the author, because nobody wants to keep them in their portfolio. This is where you have to start researching whether the company is good or whether it is mispriced or undervalued before the rest of the market realizes its true potential. Now, there are several types of filing available for you to understand or make a judgment whether the company is underpriced or overvalued. Known as these filings are maybe registration statement, disclosure statement, depending on the company or depending on the India or the country which you operate. So, friends, there are also a similar type of situation known as restructuring. Basically, what happens in restructuring is that a very good businesses has multiple profitable segments. However, when managers or insiders are optimistic about the future, meaning they are on the upcycle of the company, they try to expand more. They try to develop more manufacturing capacity, more plants, building, machinery, and whatnot. This leads to over expansion and debt on the company's books because they require money to expand the business. When the down cycle comes, they are not able to repay those debts. Naturally, in the down cycle, the revenue takes a hit and so does the profit. But the interest are the fixed cost. They remains in the book and you have to pay the interest. In that scenario, management starts to pull out the profits from the profitable segments into the losing segment. Over time, the debt rises to an extraordinary level and they're not able to repay it. In that scenario, the management comes up with a very new strategy. They try to sell the losing segment and the proceeding of the cash is used to repay the debt of the business, of the segment, of the losing segment. After this process, the new company will have profitable segments that are cash generating. This will unlock a new valuation because the previous stakeholders had tried to sell their stock which they received from the converting debt. Now, let us understand this special situation with a case study. Now, I would like to take the uh, explain this example, this special situation with an example of Tata Medical. Um, the company had around $1.6 billion in debt due to management buyout. Now, what is Tata Medical? Tata Medical is a hospital company and asset intensive business. Now, the rescue plan involved management attempting to repay the debt by selling off non-core, low profitable asset. This strategy successfully reduced the debt to around $900 million. That is a huge reduction in the leverage. This is where you start researching and reading the documents filed with the SEC. Some debts were repaid and some creditors were given the new stocks of the company. So when the new company was born, it was available at around $7 per share because the older stakeholders sold all their shares to collect their payment. Through through your research, you would have discovered two critical points. The company was poised to earn around $2.5 to $3 of free cash flow, while the similar company was available at nearly double the valuation. And the second part is you have to focus on the insiders and management. They had a huge amount of stocks, significant amount of stocks and options available on the company. Mind you, these are the people they have inside information available of the company about the growth aspects of the company. So they don't hamper their wealth by investing in a company, in any company. And the fourth step is the action plan. When management execute this strategy, we bet on selling their non-core hospitals. When this strategy plays out and they have reduced their leverage and make money from their profitable business, then the investors and the investor community starts to notice this company, which in result to the price hike or the get to the fair value of the company. Now, in this example, specific example, the company went from $7 to $21, triple the valuation. Which is triple in valuation. This is how you make money in special type of situation. Now my colleague will give you updates about the current affairs. Thank you.
Let's now talk about what major happened in the economy since the previous video we published. In the last few months, you have seen the headlines. Rupee hits a record low against the dollar. It sounds like a crisis, right? Usually we associate a falling currency with a weak economy. But if we look at the data, we see a different story. As Harish Damodaran points out, this time the fall is real. The rupee isn't just falling against the dollar, it is adjusting against the euro, pound, and the yen. But here's the twist. According to many economists, this isn't a disaster, it is a necessary correction. To understand why, we need to look at the concept called REER, the real effective exchange rate. Look at the charts provided. For years, India's inflation was higher than its trading partners, but the rupee stayed relatively stronger. This made Indian goods like textile or electronics more expensive for rest of the world compared to goods from China or Vietnam. As Mr. Sajid Chinoy argues, we shouldn't fight this depreciation. But why? This is a level playing field. China has let its currency depreciate to boost its exports. If India doesn't allow the rupee to find its natural levels, our exporters get priced out of the market. Second, the import problem. A stronger rupee makes imports cheaper, which sounds good for us as consumers, but it actually hurts local manufacturing by making foreign goods too competitive. When we import much, we when we import much more than what we export, the gap widens. By allowing the rupee to depreciate calibratedly, meaning slowly and steadily, the RBI is actually helping the closing the gap. When we import much more than what we export, the gap widens. By allowing to depreciate calibratedly, meaning slowly and steadily, the RBI is actually helping to close the gap. It acts as a natural shock absorber. It makes our exports cheaper for when we import much more than what we export, the gap when we import much more than we export, the gap widens. By allowing the rupee to depreciate calibratedly, meaning slowly and steadily, the RBI is actually helping to close the gap. It acts as a natural shock absorber. It makes our exports cheaper for foreigners to buy and encourages us to make in India rather than buying from abroad. In Chinoy's words, letting the In Chinoy's words, letting the currency depreciate is actually preferable to putting up trade tariffs because it helps the exporters and domestic producers equally without create because it helps the exporters and domestic producers equally without creating trade wars. So when you see the rupee at 87, 89 or 90 to the dollar, don't think as a weak India, think of it as a competitive India. The RBI has moved from managing the rate to stabilizing the volatility. We are letting the market find the rupee's true value so that our economy can remain resilient in a shifting global landscape. The goal isn't a strong currency, it is a strong balanced economy. If you have walked past a jewelry store lately, you have seen 1.4 lakhs. That is the price of 10 grams of gold today. Just a month ago, we were looking at 1.3 lakhs. Why is this happening? Most of the people think it's just market greed. But if we look at the economic data, we see a actually perfect storm of geopolitics and our own currency movements. First, the world is on the edge. In early January, the US military intervention in Venezuela sent a message. Firstly, the world is on the edge. In early January, the US military intervention in Venezuela sent a massive shockwave through global markets. When there is a black swan event like this, investors don't buy stocks, they buy gold. It's worth ultimate it's the world's ultimate safe haven. Combine that with a slowing US economy and expected interest rate cuts by the Fed Reserve, and you have a recipe for gold to skyrocket internationally. When the rupee weakens, gold becomes automatically more expensive for us, even if the global price doesn't move. In the last 30 days, the rupee fall acted as a multiplier, turning a global price rise, turning a global price rise into domestic crisis. The gold is in your locker now. The the gold in your locker is now worth more than ever, not because the metal changed, but because the world is becoming more uncertain and our currency is becoming more competitive. The gold in your locker is now worth more than ever, not because the metal has changed, but the world became more uncertain and our currency became more competitive. In 2026, gold isn't just an ornament, it's an economic shield. Now, over to Mr. Saurav for the next update. Thank you.
Thanks, Mohit. Let's take this forward with a quick current affairs update on China Plus One, focusing specifically on India's smartphone and electronic supply chain. Apple has exported iPhones worth $14 billion from India, making electronics the fastest growing export sector. The more important development here is happening at the component level. The government has approved 22 investment proposals worth 41,863 crores under the Electronic Component Manufacturing Scheme. These investments target core electronic components such as capacitors, lithium ion cells, and copper clad laminate, the parts that determine how much value a country can actually capture in a supply chain. This is a shift from an assembly led model to an ecosystem led manufacturing strategy. Apple has tied up with five anchor vendors, namely Tata Electronics, Motherson Electronic Components, Indelco Industries, Yusan Technology, ATL Battery Technology, and TDK Group. The objective is not just to assemble phones in India, but to localize inputs that were earlier imported largely from China. In the current global environment, where tariffs, trade disputes, and geopolitical uncertainty are increasing, companies are prioritizing supply chain resilience over just cost efficiency. India's China Plus One opportunity, therefore, depends less on assembling finished products and more on whether this component ecosystem can scale successfully or not. Thank you. Now, my colleague Tariq will take over.
Thank you, Bhumit. Now, in the next two slides, I will be giving a small update on what is happening with AI in India with related to global perspectives. First of all, we have to understand why it's very crucial to understand the AI sector. In the past 20 to 25 years, from a point of view of India, we have missed a very, or let's say, very a lot of growth opportunities related to manufacturing sectors. But on the brighter side, we have done very well in services sector. So anything major happening in AI will directly impact our services sector. So that is the reason we have to update ourselves with AI. Now, three things to keep in mind that Microsoft has committed to spending around $17.5 billion in building AI infrastructure. Now, what is AI infrastructure? That is basically data centers, which helps AI companies to store data and utilize data in a very efficient manner. Now, Google has also committed to spend around $15 billion in data centers. Now, regarding India's position, where does India stands in the global landscape? India now hosts around 2000 plus AI startups, only second to USA, which is a very growth traction we can see. And 50% of executives report tangible value from AI. This translates to real jobs, specifically 1,80,000 new AI engineers. Obviously, with this being a new sector, new jobs will be created and some jobs will be destroyed. So, coming to our next slide, every benefit has some cost related to it. And in this slides, we will focus those costs. The key requirement for running this huge AI data centers in the coming few years is going to be very big because it requires huge amount of energy and water. Basically, water will translate to energy. So by energy, I means that the amount of energy will be required by 2030 only by AI will add around 156 terawatt per hour to India's electricity demand. That is, as you can see, a huge increase from 24%, from 61 to 817. That is a 24% increase. Now, water, a single facility uses around 5 million liters daily for cooling data centers. This is a significant concern in a scenario like India, where many villages still lack a water supply. Now, the good news is that there has been a lot of, let's say, a point of view created where if AI is coming to rule like major sector, then it will uh, destroy a lot of jobs. But that is not true. Whenever there is a new revolution going on in a particular new industry, new jobs will be created, some will be destroyed. For example, let's say in the past, when the cloud uses came into the existence, the pen drive and the floppy disk was destroyed. So those engineers or those people who are employed in this industry lost their job technically because they didn't uh, innovate themselves to being used in the cloud engineering. The third major risk is regulating AI. It is very important to regulate AI because if we have done too much regulation on this new innovative industry, then we will hamper our growth. We will not become a new AI dominated country. So there has to be a balance, and that will be depend on the India's governance. So that is all from my side to update you on AI. Now my friend Saurabh will come and give you an update on economic indicators. Thank you.
We will now see what has happened in the IPO market. So over the last 12 months, total 344 IPOs hit the Indian market. They raised an astonishing amount of about 1.5 trillion rupees. Sounds exciting, right? But here is the reality check. The median return is zero. Between July and October 2025, in these just 4 months, around 193 IPOs were listed. 72% of them listed at premium, but only 50% actually delivered a positive return. And guess what? Small caps dominated the both extremes. Tank up engineers gained about 450%, whereas Valencia India had a loss of about 81%. Now here is more uncomfortable truth. Earlier, IPOs, like normally IPOs are meant for raising capital or raising for companies' growth. But now many are just an exit door for promoters or private equities. Uh, they have become an exit door for them. One live example is the BCCL IPO, a subsidiary of Coal India, which is total for sale. Means promoters are selling their equity. And second thing, sometimes it is even efficiency. So selling stake by IPO, tax will be just about 15%, 15%, instead of the 40% if the promoter wants to withdraw a huge amount of salary. So now this is about the IPO. Now let's talk about the indicators, how they have performed. So over these past six quarters, the nominal GDP has been stable, around stable. The main reason is the high growth of like public consumption. Because of that, the GDP has been growing at around eight like around 8.3% to 9.7%. Second thing, the real GDP growth rate has increased from 6.5% to 8.2%. The main reason is the GDP deflator, the inflation. The inflation has been lower because of the food inflation. Because of that, the purchasing power has increased and plus volume sales has increased. And because of that, the real GDP growth rate is up. Then, if we look at the manufacturing and service PMI, they have been stable. The service PMI has been like it has been in a, but if we look, they are above 50, means they are still expanding this sector. And lastly, the cars, two-wheelers is the auto vehicle industry. The sales has increased significantly. Why? One of the main reason is the GST rate cut. Because of that, from like 40% or 28% to like 18% slab. So because of that, what has happened? The auto sales has increased significantly. So these were the major indicators and the IPO news. So thank you everyone. So thank you everyone for watching this presentation. I hope you have enjoyed it. Thank you.